Good afternoon, everyone, and thank you for joining us. My name is Jason Lee Swee, Executive Vice President of SIA Wealth Management, and I'm joined by our founder and CEO, Jeremy Fehr. Today, we'll provide a special update on the activity of our sub-advised funds and ETFs with BMO Global Asset Management, as well as provide an insight as to what the charts and relative strength indicators are signaling to us at this time. As you know, this year has been a very difficult market to navigate for both bond and equity investors, with tremendous uncertainty within the economic and geopolitical landscapes. The feedback we're hearing from clients is that they're concerned we're entering into a long period of market volatility in both directions that will necessitate a more proactive approach to portfolio management than what was needed in the past. This is the role that we ultimately intend to play in every portfolio, and we call this approach true tactical investing. So I'll provide an overview of the most recent movements of our macro relative strength indicators, as well as our sub-advised mandates with BMO Global Asset Management, then pass it over to Jeremy to provide his insights on the current market development and potential scenarios going forward. So what has occurred recently? At the end of market close on Thursday, September 22nd, the SI Charts Equity Action Call indicator moved into the red zone, signaling heightened equity risk. Looking at the longer-term history of this indicator, this is the first time since the 2008 market crash that this indicator moved into the red zone, bounced back into the yellow zone, only to move back down into the red zone. Cash is currently ranked in the top spot, with currency, which essentially represents international cash, in the third spot. US equity is the strongest of the three equity markets, with Canadian equity and international equity near the bottom at 5th and 6th spots, respectively. Given the increased speed and volatility of the markets over the recent years, our R&D developments were implemented 2 years ago to allow for a more fluid transition between the various equity action call zones to enable our mandates to be more flexible. We added a shorter term indicator overlay to aid in our ability to navigate a faster moving market. Here's an example of these movements in real time. Looking at the BMO Tactical Global Equity ETF Fund, overlaid on the iShares MSCI World Index, which is its benchmark since mid-2020. Based on our additional indicators, we were beginning to raise cash as the markets began to top out near the end of 2021. As the move down began to accelerate in Q1 of 2022, we increased our cash weightings to over 60% by April. A quick move into the red zone in June, then back into the yellow in August. Then last Thursday, September 22nd, we moved back into the red zone again and currently sit in cash equivalent ETFs across all our equity and balance mandates. So as of the market close on Friday, September 23rd, all our equity and balance sub-advised mandates currently have 0% exposure to equities. A quick review of how our mandates have navigated year-to-date 2022. And given the nature of the market volatility in both directions this year, we feel this has been a tremendous test for all tactical strategies and also highlights the benefits of using a completely objective, rules-based, and unemotional approach to effectively navigate a very difficult market cycle. The BMO Tactical Global Equity ETF Fund is our global equity mandate consisting of the strongest relative strength stocks throughout North America and the strongest relative strength ETFs globally. Our true tactical process, as you can see, has enabled this fund to provide a smoother ride with much less downside risk than its benchmark. And should the global markets fall further from this point, this mandate will remain in defensive mode as long as we remain in the red zone. Over the past 5 years, we've experienced both a bull and bear market, and so this is a useful time period in which to analyze any tactical strategy, as they really are intended to be judged over a full market cycle. Year to date and over 1 year, this mandate is ranked in the top percentile, top decile over 3 years, and top quartile over 5 years. The BMO Tactical Global Asset Allocation ETF Fund is our tactical balance mandate, and it really is a strong option for anyone interested in balance mandates. This is one of the most flexible balance mandates in the industry with a low to medium risk profile. Interestingly, year-to-date 2022, a 60-40 portfolio of US stocks and bonds is on pace to become the second worst year in history, only eclipsed by the year 1931 during the Great Depression. This mandate has held up well in a very volatile environment for both stocks and bonds, and with its current 0% exposure to equities, is positioned defensively in case of further downside risk. Has achieved top decile performance year to date and over 1 and 5 years. And again, positive alpha over 5 years compared to negative alpha for the entire category. The BMO SI Focused North American Equity Fund, also available as an ETF, is our concentrated stock model, identifying the strongest relative strength stocks within our North American universe. Again, this mandate has reduced volatility relative to its benchmark and held up pretty well in a volatile stock environment, especially given it's a concentrated stock strategy. And as we've mentioned many times before, the macro risk management overlay is absolutely critical to any long-term successful tactical strategy. This approach has resulted in top decile performance year to date and over 1 year, and top quartile over 3 years. And even over the past month, usually a concentrated stock strategy will suffer large declines during highly volatile days. But again, our macro risk management overlay has helped to dampen the risks with top percentile performance. And again, positive alpha over a volatile 3-year period, while the category has experienced significant negative alpha. And finally, the BMO SI Focused Canadian Equity Fund, also available as an ETF, is our concentrated stock model identifying the strongest relative strength stocks within our Canadian universe. This fund has been positive for much of the year and is only down minus 1.9% year to date. A good option to pair with a traditional equity fund, traditional Canadian equity fund, because of its highly high active share. It won't look like the index or our peer group. This has achieved top percentile performance year to date, top decile over 1 year, and second quartile over 3 years. And again, positive alpha over 3 years versus negative alpha for the category. As you can see, all our mandates are actually very good risk-adjusted options to complement any of your existing long-only fully invested strategies. So why tactical investing now? Looking at the Dow Jones Index, the chart on the left, from the bottom of the market in March 2009 to the end of 2017, saw the market increase 278% cumulative return without a minus 20% correction. While since 2018, the market has already experienced 3 technical bear markets in the last 4.5 years. Many advisors I've spoken to believe the market cycle over the next 10 years will be upward trending with greater and more frequent periods of volatility. If so, has this cycle already begun? If so, this market cycle might be ideally suited to tactical strategies. It's not too late to add tactical mandates to your clients' portfolios, in our opinion, as this type of volatility could be the new norm for years to come. And now I will pass it over to Jeremy to provide his insight into what the charts and relative strength indicators are potentially signaling going forward.
Good day, everyone, and welcome to my portion of the presentation today, the Market Insights. I'm Jeremy Fehr, the CEO and founder of SIA Wealth Management and SIA Charts Incorporated. Thank you, Jason, for the first slides in this presentation, and thank you, everyone, for taking the time to either watch this live or in the recording thereafter. I think a lot of the points that Jason's brought up need to be readdressed here before I get going on the charts. Our research and development enhancements at SIA Wealth Management continue to add value to our mandates. I think it's very important for everyone to understand that not only have we been working diligently for decades now on ways to provide strategies that can work in all kinds of market conditions, but we continue to advance our technology, to advance our team, and to advance where we go in strategies for our partnership with BMO Global Asset Management on our 5 mandates. This year has been a tremendous test for all tactical strategies with a significant volatility in both directions. I think it's important to note that since January of 2021, we've seen increased accuracy with our strategies as we move forward. And I think this comes on the back of the diminishing returns that monetary policy and fiscal policy has seen in the marketplace with many of the problems that we're now faced going forward. Our relative strength process removes all the subjectivity and emotion. This is something we've always done since the early startings of this business. When I started it back in the early 2000s, we've always taken emotion out of decision. I think in times of crisis, which we stand in today and then have been in for many months and have seen many other times in history, taking that emotion off the table adds tremendous value, as emotion and hope sometimes take over on what could be more intelligent decisions as we go forward. The volatile markets may lead you to believe that it's too late to get engaged with our mandates, but I would strongly disagree with that. We're in the early innings, and I'll show you that in the charts as I show forward of risk and uncertainty in the markets, and I think it's never too late to get involved in a strategy. So please work with our team. We're here to help and to help you find ways to help manage your clients' risk. I love this quote from Mike Tyson: everyone has a plan until they get punched in the face. I've used this a couple times recently, and I think it's clear to anyone on this call today that we're seeing lots and lots of punches coming from the markets, and they're coming from different directions. So I think it's important to have a plan and to use that plan and to execute it without emotion. First place I wanted to start here is the double bubble and diminishing influence. We've got some serious problems in a post-COVID world, but I think it goes back even further than that, back to the 2008 crisis, as we saw governments implement quantitative easing around the world from 2008, 2011. We saw other quantitative easing and fiscal and monetary stimulus coming in 2016 and really pushed the envelope in 2020. So we've got tremendous debt now in central banks and corporations and consumers. This has led to many asset bubbles in housing in the stock market. And then finally has now created inflation that's spread out of those conventional asset hedges that people have been using, borrowing that cheap money and buying up stocks and buying up real estate. Food and energy have seen tremendous inflation. And I think what is clear in a post-2021 world is that central bank and government influence has been diminishing more and more, with all of their efforts coming with lower and lower returns, and they're finding fewer options because inflation has reared its ugly head and created problems that they can't avoid any further. I just have in here, this is our equity action call. I have rope-a-dope isn't working. So all those punches that are coming from the market remind me from my personal experiences looking back on 2008 more than any other time. We saw a very strong green zone going into the 2007 period. We went into the early part of 2008, saw a red zone, and then quickly bounced from that. But what we saw was when we went back into the red zone from that yellow without going into the green, we saw the big downside happen there. I can't give you any certainty that that's what we're going to see going forward, but if you look at the two sections that I've highlighted on the equity action call, we can clearly see that the similarities in where we are in that yellow zone back to red zone look similar, with a long drawn out drawdown from the green zone into the red, a movement up based on hopes and fiscal and monetary stimulus, and certainly a lot of oversold nature that we've seen recently. But there's problems that are in the marketplace, and a lot of not a lot of good news can come out. If we move to the right, we can see our current asset class rankings. Cash is ranked number one. This should give great pause to anyone who's on this call, and even those people who are not, to see cash at the top. U.S. equities in second place, and I can tell you that it's holding on by a thread, followed by currency, which is just cash and other denominations other than Canadian and U.S. dollars. We then have commodities, Canadian equity, international equity, and bonds. So bonds being ranked so low has helped equities rank a little bit higher in this downturn. But when we look at the downside that we've seen in fixed income, which we'll touch on in a few more slides here, this has hurt tremendously and has given fewer and fewer options other than pure defense when it comes to protecting your clients. So the tactical strategies, those true tactical strategies at SIA Wealth Management with our partnerships at BMO Global Asset Management become more and more important. The first slide I want to show you today is the S&P 500 versus cash. U.S. equity has been the strongest of the equity asset classes for some time. We can see that on this chart that it has been in a downtrend since the early part of 2022. We did see a bounce off the lows in June of this year up until August, but since then we're now looking at retesting those lows on the S&P 500. So when we're looking at such a broad-based index as the S&P 500, which has been one of the strongest global equity markets, seeing this type of relative strength versus cash becoming negative and remaining negative and now looking at new lows should give us considerable pause as we move forward. The next slide I want to talk about is the NASDAQ Composite. As you know, the Composite has been one of the most successful indexes over the last decade of the major global equity markets. What's important on this chart is that we've seen a retracement back near testing those June lows of 2022 on this index. If we move through that level, it would suggest that we're going to see levels probably in the high 9,000s tested. That would bring us back to June 2020 levels or those levels of our highs back in February 2020 pre-COVID. The risk that we have here, and you can see that I've drawn in a couple of black lines to serve as intermediate trend lines, is that a breach of this level could see us test those lows of April 2020 or just above those from when the bottom of the pandemic and when we started to see the rally coming back. And again, that would take us back to January 2018 levels as well. So looking at a chart like this, we can see that it's grossly extended to the upside. And with the downturn that we've seen in the equity markets, that risk is high that we could see at least a retracement back to those high 7,000 range on the NASDAQ. So it's a pretty scary thought given how much strength we've seen from those technology names and healthcare names that have been driving the NASDAQ over the past decade. But that risk is real, and we'll continue to watch this index to see if we have any changes. If we look at the S&P TSX Composite, it's fared reasonably well versus even the U.S. markets. The additional strength that we've seen on relative strength from those U.S. markets has come from currency. The U.S. dollar has been stronger than the Canadian currency and offered it some more support. The problem with Canada right now is that it's enjoyed that strength largely on the back of crude oil, which is now retraced significantly into the high 70s from those highs we saw earlier in the 120 range. The crude strength has also led to a stronger Canadian dollar that has buffered some of the extreme inflation away from us that other countries have seen. I mean, we need to look no further than Europe and other parts of the world to see what a weaker currency can do. So this weakness in crude could create even more significant problems to Canadian individuals, citizens, and of course the companies that they're supporting with that. Inflation might get a little bit stronger. When we're looking at the chart, we're watching that 18,043 level. If we go below that, that would suggest room to the 17,000 range, which is not a tremendous percentage change, but the risk lies with a movement down from there. Anything below that 17,000 level does not have as much support as one might think, and we could see a retracement that is not dissimilar to what we've seen on those U.S. benchmarks. An important chart to look at here is the US dollar versus CAD. The US dollar, as of yesterday's close, has broken up against its downtrend line. So we're now sitting in an uptrend with that. We have a little bit of resistance sitting at this 138 level. If that is breached, we should potentially see a move to the April highs of 2020 when we were in the depths of that COVID crisis. We can look backwards into 2015, 2016, where we saw similar highs. I guess it would be the starter part of 2016 where we saw similar highs. The Federal Reserve has acted and dealt with a strong US dollar previously. That's something we'll be watching for as we move forward here. It would be unclear, though, what they could do to reduce the strength of the US dollar given the large crisis that we're underway in the equity markets and other areas of the market all coming at us, which we appear to be in the early innings in as we move forward. Probably the most significant chart to talk about in my presentation today is the CBOE interest rate for the 30-year. We can look back on the data here. This goes back to 1979. I increased the percentage on this just to show the magnitude of the downtrend that we've lived in for the past 40 years and change. There are some breaks through that downtrend line if we look at lower percentages, but if we want to look at it from what has happened recently, we can see in the bottom of the chart that the COVID stimulus happened at the bottom. We saw interest rates collapse, getting down to extremely low levels during the COVID crisis. But since then, we've seen a steady rise. All that stimulus coming on the backs of a decade of doing that post 2008 has created some significant problems for fixed income, which we've all seen over the last couple of years. But more importantly, inflation. And now with the rising interest rates that we've seen, the market has been predicting this for some time. But we saw in the early part of 2022 in February a breach of that downtrend line. If we look at it at this percentage scale, we're going back 40 years, and since then it moved up strongly. Looking forward on the chart, we should expect to probably see somewhere up in that 5% range, which would be at the top part of that resistance level, with the predictions seen from the Federal Reserve that inflation is still a big problem, and what we've seen with Bank of Canada seeing higher rates from here continue to go up. I will note, though, that at some point in the future here, we probably will see a great opportunity in the long end of the curve in fixed income. Looking at the chart here, though, today would suggest that we're not there just yet. The next chart I want to look at is the SIA Market Equal Weight Index. I think this is an extremely important chart for us to look at because it's SIA's holistic view of equities around the world. We're taking into account U.S. equities, international equities, and Canadian equities in this. I've also highlighted on this chart the three declines that we've seen going back about 20 odd years. We're currently in a 12-box decline on this chart. That compares to a 17-box decline is what we saw during the COVID crisis and the start of that pandemic, and then the quick recovery based on that strong stimulus packages coming out of central banks and governments from around the world. But if we compare that to what happened on the SIA Market Equal Weight Index back in 2008, we saw a 32-box decline. This is not me correlating that we're going to see exactly that, but when we look at the equity action call, if we look at the potential problems with intervention coming into the marketplace, we still have inflation and many geopolitical risks. We can't take it off the table, and we have to examine what that is. So if you look on the right side of the chart, we can see what I've highlighted. It says same as 2020. This would be a decline that would be similar to COVID in today. And then I also have highlighted as same as 2008 from our current levels, where those levels could be. I think the first touch point is likely, given the weakness technically in the markets. We've already seen a breakdown of support on this chart. So whether that weakness comes explicitly from US, from Canada, or global, which has already been in a larger bear market for a period of time, is unclear, but we're seeing that acceleration in the US and the Canadian market. So they might contribute a bit more as we move forward. So this is an important chart. I just wanted to highlight this. And so for those of you who are on the call thinking that maybe it's too late, that I haven't moved into tactical positions yet, it appears that there's still tremendous time to do that, but the sooner the better. When we look at that chart. The final graph here is just taking a look at our mandates with BMO Global Asset Management. We've got 5 mandates on them. 4 of them have equity, one of which is bonds. So please work with our team on this. We're here to help on that. We've highlighted our research and development. We've highlighted the volatility, and we've highlighted what tremendous work we can do at SIA to help and work with our clients. So with that, I'm going to turn it back over to Jason for final conclusions. We wish you all the best, and we look forward to working with you in the future.
Thank you, Jeremy, and thank you to everyone for joining us. If you have any questions, please don't hesitate to reach out to us or our partners at BMO Global Asset Management. You know, we believe this approach to investing is so valuable for the years ahead. We've actually developed a workshop called the Tactical Portfolio Workshop, which essentially provides the understanding and tools you need to run tactical strategies simply and effectively. We want to make tactical practical for you and your business. We will officially launch this workshop towards the end of next week, and we'll send out the invites for the webinar in the early part of next week. So please check your inbox for those invites. Thank you again, and have a great day.